Welcome to vTalkInsight, Allocator's Lens Daily for March 12, 2026. Cross-asset conditions are being pulled between an intensifying oil shock, stubborn inflation signals, and equity markets that still look remarkably relaxed with low-risk premia and rich valuations. Today we will connect how that tension is playing out in equities, rates, credit, currencies, and commodities, and what it could mean for portfolio risk over the coming months. In equities, the central question is how long lofty pricing can coexist with such a severe energy and geopolitical backdrop. Risk premia across stocks and bonds are described as historically low, while broad equity valuations sit near their highest levels in roughly 2 decades, even as uncertainty rises. Market pricing effectively assumes that the current oil shock will be short-lived, with some estimates suggesting traders are treating a quick resolution as almost a base case. Yet commodity specialists argue that the odds are closer to a coin flip, pointing to a meaningful risk that equities are underestimating the potential for a deeper drawdown. Headline indices still look orderly, with recent large-cap benchmarks barely moving on some days, even as volatility gauges stay elevated. But beneath the surface dispersion is intense. The average S&P 500 stock has endured a mid-teens drawdown, and typical NASDAQ constituents have seen peak declines closer to the high 20s. Highlighting ongoing rotation rather than broad capitulation. Energy is the clear winner in this regime. The sector recently gained around 2.5% in a single session, while most other S&P groups fell, and oil and gas shares had already been trending higher before the latest Middle East escalation, suggesting more than just an event trade. The flip side is visible in energy-sensitive and consumer areas. Airline stocks have sold off sharply, as rising jet fuel costs threaten margins. Analysis suggests that a 10% increase in average jet fuel prices can cut earnings per share by up to 20% from major carriers, with even larger hits for the weakest balance sheets. Consumer-facing names are also feeling strain. Households are trading down on discretionary snacks, and large packaged food companies are reporting share price pressure as brand loyalty erodes under higher food and energy bills, reinforcing the idea of a real income squeeze. Against that, there are pockets of strong growth narratives. Enterprise software and AI remain in focus. Global IT spending is projected to more than double between the middle of this decade and 2029, and recent results from major database and cloud provider showed an AI-driven revenue upgrade and double-digit share price surge off very light positioning. Valuation signals are not uniform across the equity complex. Emerging market equities have outperformed developed peers year-to-date, helped by stronger earnings revisions, yet still trade at roughly a 30% discount on price to earnings and around a 50% discount on price to book versus the main United States benchmark, implying considerable room if the growth story holds. Within software, the broad sector derating has taken forward earnings multiples down to about 16 times, now below the overall market. Some see that as a more reasonable entry point for AI-linked growth, though company stories diverge. One large cloud and enterprise name is using heavy capex and rising leverage to chase AI demand, while another major software platform plans a large, debt-funded buyback that credit agencies have already treated cautiously. Putting this together, the base case in some commentary remains for modest but volatile single-digit equity returns out to 2027, but with a higher chance of a 10 to 15% correction or worse if the energy shock lingers and squeezes margins more aggressively. Turning to rates, the oil shock is directly reshaping the inflation and growth calculus that underpins yield curves. Estimates suggest the current energy spike could shave about 0.5 percentage point off global GDP growth while adding roughly 1 percentage point to inflation, with a 10% rise in oil typically feeding around 0.4 of a percentage point into consumer prices over time. More granular work points to a 20% jump in retail gasoline alone, potentially lifting headline inflation by about 1 percentage point and creating a meaningful real income shock, especially for lower and middle income households whose budgets are already stretched. Against that backdrop, central banks look set to stay cautious. In the United States, the Federal Reserve is widely expected to keep rates unchanged at the next meeting, focusing on core inflation and aiming to look through temporary food and energy spikes unless they trigger second-round effects like wage price spirals or profit-led inflation. At the same time, Recent reacceleration in key price gauges, such as core personal consumption expenditures, is seen limiting scope for cuts, even as non-farm payrolls soften. In Europe and the United Kingdom, the bias is even more hawkish. Market expectations for European central bank hikes have risen as energy-driven inflation lingers, and the Bank of England is now thought likely to delay its first cut until late in the year. Market pricing reflects this tension. The 10-year United States Treasury yield has risen in 6 of the past 7 sessions, with another modest climb of about 5 basis points recently, reinforcing the sense that traders expect policy rates to stay elevated for longer. Commentary highlights a stagflationary pattern of falling equities, rising yields, and higher energy prices, which undermines the traditional diversification role of duration. Even so, some see emerging opportunities in high-quality fixed income. Short-dated treasuries are being framed as liquid hedges against growth and credit shocks, while selective duration in core sovereigns and investment-grade bonds could regain their defensive properties if a harder landing pushes long end yields lower. There is also interest in specific markets like 5- and 10-year United Kingdom gilts, where yields around the mid-4% range are viewed as appealing relative to peers, especially if domestic inflation gradually recedes once the current oil hump clears. In credit, the picture splits between liquid public markets and more opaque private channels. On the surface, investment-grade and high-yield spreads remain tight despite geopolitical tensions, which supports the narrative of an ongoing high-risk bull market and signals that public bond investors are not yet pricing a severe downturn. Strong demand for high-quality corporate paper reinforces this. A major global technology and retail platform was able to place an exceptionally large multi-currency bond deal, with heavy oversubscription in both United States dollar and euro tranches, even as it prepares for extremely high annual capital expenditure on AI infrastructure. Beneath that calm exterior, private credit is showing mounting strain. Banks have kept balance sheets relatively tight, leaving private lenders to absorb riskier loans, particularly in software, where business models face disruption from AI and growth expectations are being recalibrated. A large money center bank has reportedly marked down private credit loans to software companies and tightened collateral terms on financing to private credit funds, while managers of semi-liquid vehicles are coping with a surge in redemption requests, in some cases imposing withdrawal limits. At the same time, distressed investors are circling, offering liquidity to fund investors who want out at discounts, and private credit platforms are moving toward more frequent portfolio valuations to address concerns about stale marks. For now, this stress is generally seen as idiosyncratic rather than systemic. Commentators emphasize that large banks look fundamentally sound and that public credit markets are relatively insulated, in part because their exposure to the most speculative software borrowers is much lower than in business development companies and private funds. Still, individual corporate balance sheets warrant scrutiny. One large enterprise software and cloud company carries elevated gross debt and is expected to generate negative free cash flow for several years as it builds AI data centers, while another major software name plans to triple its debt to fund share buybacks, a move that has already prompted a rating downgrade and raises questions if the hope for AI-driven growth fails to materialize. Overall, credit remains functional, but the private segment looks like an early warning system for how higher rates and slower growth could interact if the energy shock persists. Currency markets are closely tied into this mix of energy risk and shifting rate expectations. Persistent tensions in the Middle East and rising oil prices are expected to support United States dollar strength as global investors seek liquidity and perceived safety during geopolitical shocks. Historically, this kind of dollar outperformance can last several months after major events, and it effectively amplifies the energy shock for import-dependent economies that also face higher local currency oil prices. Interestingly, Bitcoin is behaving less like a haven and more like a high-beta risk asset, with recent price action tracking equities rather than providing protection when geopolitical headlines worsen, underscoring its growing integration into the mainstream risk complex. In contrast to the haven bid for the dollar, commodity-linked currencies such as the Canadian and Australian dollars have shown resilience, reflecting support from stronger materials and industrial activity and ongoing capital expenditure tied to resources. That aligns with a broader narrative of improving emerging market robustness. Many developing economies now sport healthier balance sheets, lower leverage, and less reliance on foreign currency debt than in previous cycles. And their equity markets have outperformed developed peers this year with superior earnings revisions and still sizable valuation discounts. On the structural side, regulatory changes allowing broker-dealers to custody tokenized securities without separate licenses could gradually lower operational barriers for traditional institutions to engage with digital assets, adding another dimension to the FX and cross-border capital flow story over time. Commodities, and oil in particular, remain at the heart of today's regime debate. Maritime security threats, including mining and attacks on vessels in a key Middle Eastern strait, have effectively shut down a vital shipping route, disrupting flows of crude, gas, fertilizers, and other goods. Estimates suggest that more than 10 million barrels per day of supply have been knocked out even after assuming maximum strategic reserve releases, and restarting around 6 million barrels per day of offline regional production could take roughly 4 weeks, underscoring that even a rapid de-escalation would not restore normal conditions overnight. Policymakers are responding with unprecedented tools, but physical constraints limit their impact. The International Energy Agency and its members have agreed to release about 400 million barrels of emergency oil stocks. Yet that covers less than 10 days of lost supply and could take up to 200 days to deliver fully because of flow rate and logistic bottlenecks. Past episodes show that large reserve releases have not reliably calmed markets. In some recent cases, crude prices were higher just a week or two after the announcement, and there is a risk that such steps are interpreted as signals of policy anxiety rather than durable solutions. At the same time, inventories are being drawn down quickly. Many governments have underfunded replenishment of their strategic reserves, and hoarding behavior by both nations and individuals is amplifying demand, echoing dynamics seen in earlier oil crises. The macro spillovers are clear. Rising crude prices compounded by lingering tariffs are squeezing consumers and raising costs across transportation and food, with analysis pointing to headline inflation potentially rising by around 1 percentage point from gasoline alone and year-end consumer price inflation drifting into the 3 to 3.5% range if oil holds in the mid-$70 to $100 band. This reinforces stagflation signals already visible in cross-asset moves where equities slip, bond yields edge higher, and energy outperforms. Strategists warn that current equity pricing effectively assigns about an 80% chance to a short-lived oil shock, whereas the underlying geopolitical and logistical realities may argue for probabilities closer to 50-50, highlighting an underappreciated tail risk. Looking beyond the immediate shock, some see a structural shift from an asset-light, tech-dominated era toward an asset-heavy regime in which hard assets like metals, gold, and oil, as well as diversified resource and energy infrastructure companies, are positioned for longer-term resilience. That perspective aligns with renewed interest in defensive, cash-generating hard asset exposures and helps explain why energy equities began outperforming well before the latest conflict erupted. Stepping back across assets, the common thread is tension between an increasingly severe energy shock and markets that, outside of commodities, still look relatively complacent. Equities carry low-risk, premia, and rich valuations while rotating violently beneath the surface. Rates are grappling with higher-for-longer inflation and delayed cuts. Credit spreads remain tight even as private lending platforms creak, and the dollar is firming as oil and geopolitical risk pull capital toward perceived safety. For allocators, the balance of risks appears to be shifting towards stagflationary scenarios in which growth slows, inflation stays sticky, and diversification from traditional stock-bond mixes becomes harder just as it matters more. Watching how the oil supply situation evolves, how central banks respond to core inflation versus headline spikes, and whether private credit strains migrate into public markets will be key to understanding the next phase of cross-asset repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.